It's often said in the alternative financial news, for example, by commentators such as Peter Schiff, that all the dollars being printed, all the fiat currency being printed, is not really affecting consumer prices that much like it normally would, because most of those dollars being printed are being invested, are basically being used to inflate the stock market and other financial assets such as derivatives, right? That's what's commonly being said. And they're following that up by saying, oh, well, now it's going to start affecting consumer prices, causing consumer prices to rise in inflation, price inflation, because of the stimulus checks that the U.S. and other governments are giving their citizens this year. So because now they're actually printing money and putting it directly into people who spend it rather than into stocks and derivatives and other financial assets where people mostly hold on to it, now it's going to cause prices to rise, right? I think that's wrong, mostly wrong, because mainly because the amount of money they've been printing over the years and putting into the stock market to cause stock markets to skyrocket to insane levels, unsustainable levels, is very large compared to the tiny amount of money that they've given people for stimulus, right? So what's something that will actually cause consumer prices to rise? First of all, consumer prices have been rising significantly. The reason the consumer price index, the official measure of consumer price inflation, is only, I don't know, less than 1% or 1 to 2% most of the time, is because it's hedonistically adjusted to always show it to be low. Their goal is to have it be low, so they simply change the algorithm, the basket of goods they use to calculate it, when it's going to be getting too high. So if you look at the actual basket of goods as it used to be measured back in the 70s, we have inflation of 8 to 10% a year. So that means every single year your savings are losing 8 to 10% of their purchasing power, which is pretty astounding. Even in the last 10 years, you can remember prices for a lot of things, especially food, being lower 10, 20 years ago. So something that's actually going to cause consumer prices to rise more is profits from stock price increases going into consumers' hands, right? So what's been happening in the last year or so is this big shift from institutional traders to retail traders. So institutional traders are big, massive companies like hedge funds that purchase stocks, right? Invest in the stock market and other financial assets. Retail investors are like basically young millennials who install trading apps on their phone like Robinhood, or they use sites like Ameritrade or E-Trade, right? Those are retail traders. Basically, retail traders are amateurs who don't really know what they're doing, but they just watch a bunch of YouTube videos and take an online course in stock trading. They think they know what they're doing. Institutional investors generally have a better big picture of the market. So what happens at the end of every stock market bubble, when it shoots up like that, institutional investors will need to leverage the risk. They have requirements. They can't keep holding on to stocks when they're shooting up ridiculous amounts, like for example, Tesla has been doing. So they have to sell, also because they know it's going to crash. And who buys it? Retail investors, because they're seeing it go up. It's starting to catch their attention. Stocks never caught their attention when it was going up. You know, when you would get 2% or 5% gains in a year, no one was really paying attention. But now when you can get 30 or 40% gains in a year, or even 100% in some stocks, or more if you use leverage, people just start to pay attention, and they get the fear of missing out, and everyone piles into Robinhood and all these other trading apps. So what you have is amateurs piling onto the scene and buying up all the stocks that the institutions are selling because they want to get out of it, because they know it's really frothy and dangerous and risky. So that's what's happening. And now, of course, most of those people are going to lose all their money when the stock market crashes. But in the meantime, there are a lot of them that are actually realizing massive gains and are smart and are selling them. So you are having millions of dollars of profits that would have been going into the books of the big banks and investment companies and hedge funds, who would just be reinvesting it back into the financial assets after paying their costs. Instead of that money staying in financial assets, it's going into the real economy, because people who make all those gains from stocks and are smart and sell it before it crashes are going to be buying cars and houses and having renovations done on their homes, and buying consumer goods like electronics and just buying more food and things like that. So that's what can cause consumer prices to go up. Maybe my last words on the topic. Try to learn a little bit about price inflation versus money supply inflation. Inflation used to always mean price inflation, but then we had this weird thing now in the last few decades where money supply inflation does not directly lead to consumer price inflation, and there are a lot of reasons for that, which I kind of just described. Have a great day, everybody.